Hello students, this is your faculty, Dr. Shweta Srivastava, Associate Professor, School of Management, BBD University. Today I am going to discuss with you the basics of investing in a stock market for the paper Investing in a Stock Market with the code GE37807. The very first question which comes in the minds of every person is, why do we need to invest? By seeing the rate of inflation and the uncertainties prevailing in the market, everybody has to invest. You can call it a necessary evil. So, by investing a portion of your income, you allow your money to grow and work for you. Even after the retirement, you allow your money to work for you. Similarly, if you want to compensate for the inflation, you need to grow your money. So, there are three parameters on the basis of you can select your investment avenue. But students, you have to keep this thing in mind that these phenomena, these parameters do exist, but they are highly subjective. They depend upon the risk appetite of the investor. So, while investing in any of the investment avenue, you need to assess the three things. First is the return you are getting out of that investment. The safety, it means the risk exposure, and liquidity. Liquidity means how readily the security is sellable in the market. If the security is not readily sold in the market, you are going to make your capital idle. So, there are various avenues with the help of which you can grow your money. So, basically, we categorize them into different asset classes. So, if you start, you can go buy mutual funds, or you can go buy post office funds like monthly income schemes, or you can go buy stocks or equity shares, which are highly popular classes of asset. So you have to understand that why this paper has been incorporated in your syllabus in the graduation only. Because investing is beneficial as early as you can. You have to understand the power of compounding. So if you start investing early, it will not only help you to build your wealth, but also increase the probability of reaching the financial stability at an early age. And after retirement, you will be financially safe. So for that, you have to understand the power of compounding. So power of compounding means an apple for an apple. So in simple terms, compounding interest means interest on interest. So each time you earn interest on your capital, the future interest will be calculated on the total capital. So it becomes the principle for the next cycle. So this allows exponential growth for your interest. So students, you have to understand that if you start investing early in your life, you are going to get huge benefits. So as I told you in the previous slide also, that if you starting early, you are going to raise your capital. So I am just going to tell you the difference between a person who has started investing at the age of 25 years and at the age of 35 years. So students, you can see the difference at the age of 60 years. A person who has started investing at the age of 25 years, he will be getting rupees 1.59 lakhs at the age of 60 years. And now see the person who has started investing at the age of 35 years. The capital which you get at the age of 60 years has dropped drastically. That is rupees 34.82 lakhs. So you have to understand that it is always beneficial to start investing early. So to start investment early in your life is always a good idea. This will help you in achieving your financial independence, it will help you in fulfilling your dreams, and it will help you to retire early. All of us are seeing a lot of pressure in the corporate world. So the workable age has reduced drastically. So at the young age, most of the persons are suffering from many kinds of health ailments. So if you wish, you have proper financial backup, you can retire early. So this benefit you can avail only when you start investing early. So now the next question which comes in your mind is to how to choose a security for investment. But before going for investment, you have to understand that there is no thumb rule, because every investor has a different appetite. He has or she has a different financial objective, but more or less we generally compare three things uh, for zeroing in for a security. So the first is return. Return is the difference between the amount you invest and the benefit you get at the end of the maturity. So a security which gives you higher return is always the preferable option. Next, you have to take into consideration is the safety. Safety from the company's point of view, safety from the government's point of view. So what is the risk exposure for that particular security? Right? So there may be solvency risk, there may be liquidity risk. So these types of risks I'll be discussing with you in the future slide, in the future classes, where I'll be dealing with the risk and return proportion. The next comes liquidity. As I told you in the previous slide also, liquidity means the saleability in the market. So if the security is easily tradable or saleable in the market, is it easier for you to convert your capital into ready cash? And if the security is not saleable in the market, that will keep your capital stuck, right? So before choosing for a security for investment, you have to consider three parameters, that is return, safety and liquidity. So students, in this slide I'm going to discuss with you the risk reward relationship. See, students, you have to understand that there is no investment product available in the market which has no risk. So these types of products do not exist in the market. Even if the bank deposit or PPF have a low degree of financial risk. You all have witnessed the case of Lehman Brothers. You all have witnessed the case of Yes Bank. So you cannot say that bank deposits or other government deposits are 100% safe. Yes, they do come in the category of low risk. So if you have low risk appetite, you should go for bank deposits, PPF is public provident fund, post office products, or debt related, where you have at least assurance for the interest, and at the time of maturity you get your capital. Then comes the mutual funds, right? Secondly, you have to be aware of all those return schemes which promise for unrealistic returns, right? They are always exposed for high degree of market risk. So you should not invest all those companies who are promising unrealistic returns, or they promise to give huge returns which is not justifiable, right? So in the high risk category we have derivatives like options, futures, swaps, and equity, pure equity, or equity related products which we talk like indirect equity. So students, you have before investing in the market, you should properly analyze the risk exposure for each and every class of asset. So this is all from my side. Thank you.